Well, thanks, Brandon, for joining us today. I've got Brandon Forler here from Unlock Your Home Mortgages with Mortgage Architects. And just great to have you here, Brandon. I wanted to jump on the call with you so we could send this out to my clients and just give them a little sort of a snapshot so they can understand maybe a little more nuance to what's going on in the market right now. We saw this week that the Bank of Canada held its rate at 2.25. Is that correct?
That's correct.
And you know what? For my buyers, I'm not too excited about that, obviously, because it means that rates aren't likely to change. But it's not really just about that. And I think it's really important for people to understand maybe where do we go from here? What do we do with this? And so let me just hand it over to you. What are your thoughts?
Yeah, so you're right. Bank held for 2.25. And there's been a lot of back and forth prior to this. You know, are they going to cut? Are they going to stay? Are they going to raise? There's a lot of press right now from all sides. And so what I'll say is that the reason that they held was because of economic uncertainty. And so we have a couple things at play here. One is inflation and the economy. Two, we have the impact of the conflict in the Middle East, right? So and not to mention, well, best way to say this is we are heavily influenced by what happens below us in the States, what happens in the global economy. Now, one important thing to note is that for variable rates, that's all Bank of Canada. For fixed rates, those are bond yields. And sometimes people get that confused because with what's going on right now, you know, every time something changes down in the States or overseas, fixed rates have been doing this. But as you'll notice, I think it's the 5th time that the bank held the rate. So for 5 straight times. So it's been pretty stable. So the big thing to note here is that while everything has been stable, they're taking on a wait and see approach. And what they're waiting on is if the US imposes new trade restrictions, then that's going to be a major hit, right? And so they actually may need to decrease the rates to stimulate the economy. So basically, the Bank of Canada took a wait and see approach because of economic uncertainty. We know that. Now, on one side, if the US opposes new trade restrictions, then that's going to put us in a tight spot, right? And so the only way you can kind of influence that is by decreasing the rates. So we may see a decrease if that happens. On the flip side, if the conflict in Iran continues and the inflation or the price of energy right now and the price of oil, if that starts to have a more general impact on inflation, then we're going to have to increase rates. So on one side, we're saying if this happens, which may actually happen, it'll go down. And if this happens, which is kind of happening, it may go up. But we need a crystal ball, right? So my takeaway from this is that right now, variable rates are a lot better than fixed. We've kind of returned to that pre-COVID where they are more, they're lower. Having said that, you also have to take a look at how risk averse is a buyer right now. So while a variable rate is going to be much lower, and when I say much lower, I mean that right now, some of the disparity between the variable and the fixed, we could withstand maybe 2 hikes, and then we would be the same as the fixed. So it's significant in my opinion. And what I'm taking away from that is if you're risk averse and you want to stay with fixed, then you can kind of call that an insurance policy. And what I mean by that is you can sleep at night. You're not concerned about, you know, for the next 3 to 5 years, am I going to have to worry about what's happening with my mortgage? If you want to take the risk and go to the variable side, you will have that discount, but we can't say for how long. Now, I find a lot of my clients right now are actually taking variable rates. And full disclosure, we just redid our own mortgage and I took a variable rate. And it's because COVID threw everything out of whack. And it's impossible for us to say if that's going to happen again. Historically, hopefully not. I think we're at a more stable point, and the Bank of Canada has shown that it's been able to weather the storm that is Donald Trump, the Iran conflict, all of that, the inflation post-COVID, because we're still seeing that, right? Now, in my opinion, it's a safer bet than it was during COVID and probably back beforehand. But if people are sitting on the fence right now and they're looking for rates to go down, my biggest piece of advice for them is, if you're going to wait for rates to go down, what happens when something becomes cheaper? It gets, it gets more attention. So more people are going to flood the market. And when more people flood the market, what happens to the things you want to buy? Well, just like inflation, they go up. So now these homes that you're competing for, it's great that maybe your interest rate went down 0.25%. But if you're paying, $50,000, $60,000 more, like, where is it that you want not to experience the money, right?
Yeah.
Do you want to have a more affordable home, or do you want the more affordable rate? And we take a look at affordable rates, 0.25% is not making the big hit that a lot of people think it's making.
Right. Yeah. Yeah. I think that's always the I don't know, just the caveat that I try and get people to see is you always have to think about this in a longer term. Like, we won't always say that we have the lowest rate and we get the lowest purchase price. And it's like, well, that's just not how it really works. Like you said,
yeah,
right now, the benefit for buyers right now is maybe there's less inventory, but the benefit is you're going to get a really pretty decent price on most categories of homes in Calgary. So that's a really good plus, and it's going to be long term, right? So the price over the long term, like you said, you get to renegotiate your mortgage rate, every few years, 3 to 5 years or so, and so that's going to change anyways. But the price and what you pay originally never changes.
Never changes. No, you're absolutely right. And so when I'm on calls with clients and we're trying to, because I get all the time, what would you choose, or what should I go with? It's, we have to take a look at the full scenario. Do you want to pay less interest? Do you want a lower price point for your budget? Or do you want to pay off your mortgage faster? And so if mortgages are amortized between 25 and 30 years, you're going to have 5 to 7 terms, like you said. So you have to think right now. What's right now? And for my wife and I, we bought our first house. She was pregnant. We had no kids and a lot less money just starting out.
Yeah.
Looks a lot different than our second home in a different province with 3 kids, established business. Like, this stuff is a lot different. And so for us, we picked 2 terms in that house, and we're in our second term of this house. And those were 4 different scenarios that we got through and that we chose based on what life was going to be like in those 3 to 5 years. What I will say is that for variable and fixed, you have that option with a variable where if you're getting a little antsy, if prices are going up, or there's a little bit more turmoil out there, you can lock that in. So if you want to convert it to a fixed, there's always an option there too. And if you want to get out of it, or if you can sell the home even earlier, then the penalty is often way more affordable than a fixed. So there are options there. Like, I know it really sounds like I'm pining for variable right now, but just like the risk, if prices decide to go up, you're still covered. If they go down, hey, that's great. And if they remain the same, then you still have all that, those safeguards in place.
Yeah, I mean, it's a worthwhile conversation right now. When fixed rates are below 2%, well, yeah, of course, there's no reason to have a conversation about it. There's no reason to really put it on a spreadsheet and try and figure it out. You go lock in as long as you can.
Yes.
Obviously, with that, I think everybody knows life changes, right? And as much as we'd like it to, in many ways, stay the same, life happens, and job, relationships, whatever it is, kids, things change. And so, a variable definitely offers some different options, like you mentioned, that could be beneficial, particularly in this type of market. So that's great.
Yeah.
What about for those who are, because here's the other thing, is it's not always just about buyers. When we're talking about rates, those who are refinancing, maybe have to consolidate. What are some benefits along those lines?
Yeah. So one thing we're seeing a lot now with everything costing so much, you go to the grocery store, heaven forbid now, is credit card rates and the amount people are holding long term on these high interest debts. So I mean, a credit card sitting at 19 to 21%. We're seeing a lot, in the $15,000 and up range when someone comes to us for a refinance. Well, if your mortgage rate is 4%, is 4.5, 4.25%, the savings monthly is ludicrous. So what we do is we have like a special budget and spreadsheet that we go through with clients for refinances where we say, this is how much your interest is costing you per month. Sure, maybe you had like a COVID rate where you had like a 1.75 or 2%, and now you have to go into like a 4 something. Well, what is the cash flow? What does that mean to you? Are you paying $2,000? Like, how much is your debt? If your debt is costing you $2,000 a month and it's not going down, then hopping into say a 4.5% or a 4.2% is a massive savings. You're able to get that money back in your pocket. And again, yes, when you refinance, you are consolidating your debt. So maybe we're consolidating $50,000 worth of debt. We're taking that $50,000 and we're spreading it out for maybe 20, 25 years, depending on what that renewal is. And so that piece of debt, not only is it cheaper, but it shrinks completely, almost completely. You want. But the big piece there is just talking about how do you manage that once you've paid it off too. So yeah, we're seeing a lot of people right now that it's not just so much about they had this fantastic rate and now it's going up. It's while this is happening, every day is getting more expensive, right? And so there are options for that.
Yeah.
And one part, if we're talking about these like sub 2% rates, what not a lot of people realize is that is the Bank of Canada's way of helping us out economically. So if you have rates at like 1.75%, you don't want rates that low. I want rates that low for my wallet. My budget wants rates that low, but the economy doesn't want rates that low. That was when we couldn't find toilet paper. That was when you couldn't go to the store and buy a bottle of water. People were hoarding it, right? So realistically,
we also saw what it did to prices here in Calgary.
Exactly.
20 to 30% jumps in a matter of 2 or 3 years.
Exactly. So to that point, cool. You can take the 2%, but then you're spending 30% more on a home, and 30% on a home is a lot compared to 2 to 4%. Yeah.
Yeah, for sure. Good.
I think that if people are looking at, what's going to happen in the future, I would say the governor of the Bank of Canada, all these economists, brokers like myself, we can't tell the future. But if we're looking at trends and if we're looking at what's to come, talk to somebody you trust. Get a second opinion if you need to. But right now, with our 5th hold in a row, I think that kind of speaks for how things are being managed right now.
Yeah, for sure. Well, I appreciate it, Brandon. I appreciate the insights and on a side that I'm not as versed in. So thanks so much. And thanks for taking time for us today and for the great information. Appreciate it.
Thanks, Kelly. Always a pleasure.